The American stock market has always been a powerful engine of wealth creation, a barometer of global confidence, and a mirror reflecting the future of innovation. But as we enter 2026, a fundamental question hangs over Wall Street, one that divides the most seasoned investors and defines the risk for every retirement account in the country. Is the historic, multi-year rally a testament to genuine economic and technological transformation, or is it merely the prelude to a painful reckoning? The S&P 500, the benchmark for U.S. financial health, has soared to unprecedented heights. After a powerful run in 2024 and 2025, the index now sits near 7,000 points. The consensus among major Wall Street strategists, including firms like Goldman Sachs, projects the index will climb further, with some targets pushing the S&P 500 toward 8,000 by the end of 2026. This would represent a total return of approximately 12% for the year, a figure that, on its own, suggests a healthy, ongoing bull market. But look closer, and the numbers begin to whisper a different story. The market's current valuation metrics are flashing red, hitting levels not seen since the most infamous market peaks in history. The sheer speed and narrowness of the gains have created a profound tension. We are faced with a paradox. A market supported by the strongest corporate earnings growth in years, yet priced at levels that historically precede significant downturns. This is the $8 trillion question, the difference between a new era of prosperity driven by artificial intelligence and a devastating collapse of a valuation bubble. Understanding the 2026 outlook requires us to look beyond the headlines, to dissect the metrics, and to compare today's reality with the ghosts of market history. The stakes are immense, not just for the titans of finance, but for the millions of Americans whose financial security rests on the answer. To determine if the market is fundamentally sound or dangerously inflated, we must turn to the core tools of financial analysis, valuation metrics. And by nearly every historical measure, the U.S. stock market in early 2026 is priced for perfection, if not beyond. Consider the forward price-to-earnings ratio, or forward PE. This metric compares the current stock price to the expected earnings per share over the next 12 months. As of January 2026, the S&P 500's forward PE stands at approximately 21.8x to 22x. This is a critical number. It matches the peak valuation seen during the post-pandemic exuberance of 2021, and it approaches the record high of 24x recorded during the peak of the dot-com bubble in 2000. For context, the historical median PE ratio for the S&P 500 is closer to 15x or 16x. The current ratio implies that investors are willing to pay a premium of nearly 40% above the historical average for a dollar of future earnings. The picture darkens further when we examine the Shiller P ratio, also known as the cyclically adjusted price-to-earnings ratio, or CAPE. This metric smooths out cyclical fluctuations by using the average of the last 10 years of inflation-adjusted earnings. In early 2026, the Shiller P is estimated to be in the mid-30s. While this is below the extreme peak of 44x seen in 2000, it is significantly higher than the historical mean of 17x. The only other time the Shiller P has been this elevated was in the run-up to the 1929 crash and the 2000 dot-com bust. Perhaps the most alarming indicator is the Buffett Indicator, which measures the total market capitalization of U.S. stocks against the country's gross domestic product. Warren Buffett famously called this probably the best single measure of where valuations stand at any given moment. As of January 2026, this ratio has reached an all-time high of approximately 222.5%, surpassing the previous record of 200% set in 2021 and far exceeding the 140% peak of 2000. Historically, a reading above 100% suggests the market is significantly overvalued. The current reading of 222.5% suggests a market that is not just overvalued, but potentially sitting on the most stretched valuation in modern financial history. This indicator, which has historically reverted to the mean, suggests that for the ratio to normalize, either GDP must accelerate dramatically or the total market capitalization must contract significantly. The fact that the 2026 reading is 122.5 percentage points above the 100% threshold, the level considered fairly valued, underscores the extreme nature of the current market premium. This historical context provides the most potent ammunition for the bearish argument. The bear case rests entirely on these numbers. If history is a guide, the market is due for a severe correction, potentially a 30% to 50% drop, simply to revert to its long-term mean valuations. Yet the bull market persists, defying the historical warnings of the valuation metrics. The primary defense of the current market level is a powerful, two-pronged argument centered on earnings and technological disruption. First, the quality of earnings is fundamentally different today than it was during the dot-com era. In 2000, many of the high-flying technology companies had little to no actual profits, relying instead on speculative future growth. Today, the market leaders, the mega-cap technology firms driving the S&P 500's gains, are generating massive tangible profits and prodigious free cash flow. Wall Street analysts project that S&P 500 earnings per share, or EPS, will grow by a robust 12% in 2026, following strong growth in the preceding years. This earnings power provides the fundamental base for the continued bull market, as argued by firms like Goldman Sachs. The high P/E ratio, in this view, is not a sign of irrational exuberance, but a rational reflection of the market's confidence in this sustained double-digit earnings trajectory. Second, the market is being driven by the transformative power of artificial intelligence. This is not a speculative internet fad. It is a fundamental shift in corporate productivity and economic output. The AI investment cycle is moving into its next phase. In 2025, the focus was on the infrastructure build-out, with the largest public hyperscale tech companies investing approximately $400 billion in capital expenditures, a 70% increase over 2024. In 2026, the narrative is shifting from capital expenditure to AI adoption. The expectation is that the growth rate of this investment will decelerate, but the focus will move to companies across all sectors, boosting efficiency and generating new revenue streams through the use of AI. This transition suggests a broadening of the market rally beyond the immediate AI infrastructure providers. The bull case is that AI is not just a new sector, but a new general-purpose technology that will permanently raise the ceiling on corporate profitability and, therefore, justify a permanently higher market valuation. Proponents argue that the productivity gains from AI adoption, from optimizing supply chains to automating customer service and accelerating drug discovery, will translate into sustained, above-average profit margins for the next decade. This structural change, they contend, renders historical valuation averages obsolete. The market is simply discounting a future of radically higher corporate efficiency, a future that was not possible in 2000 or 2008. The 12% EPS growth projected for 2026 is seen as merely the beginning of this multi-year earnings supercycle. In short, the bull argument is that this time is different, not because of investor psychology, but because of unprecedented corporate profitability and a technological revolution that is only just beginning to bear fruit. The most significant structural risk to the bull case is the market's extreme concentration. The S&P 500's performance has been overwhelmingly dependent on a handful of mega-cap technology stocks, often referred to as the Magnificent Seven. This concentration of market capitalization is the highest on record. In 2025, these top tech stocks accounted for an astonishing 53% of the S&P 500's total return. This narrow leadership creates a fragile market structure. If the earnings or growth prospects of just one or two of these dominant companies falter, the entire index is vulnerable to a sharp decline, regardless of the health of the other 493 companies. The concentration risk is compounded by the fact that the market is essentially pricing in a near-perfect outcome for these companies. The forward P/E of 22x is heavily skewed by the high multiples of these leaders. If the anticipated AI-driven productivity gains do not materialize as quickly or as broadly as expected, or if regulatory scrutiny increases, the downside risk is immense. Furthermore, the concentration creates an idiosyncratic risk. Investor dependence on the continued strength of the largest U.S. companies means that any company-specific misstep, a product failure, a data breach, or change in management, could have an outsized systemic impact on the broader market. The bullish counterargument is that this concentration is simply a reflection of the economic reality. These companies are the most profitable, most innovative, and most dominant in the world. They are the natural winners of the digital age. However, history shows that even the most dominant companies can be dethroned, and the market has a mixed track record regarding the eventual success of first movers in periods of major technological innovation. The current structure means that the market's fate is tied to the continued, flawless execution of a very small group of corporate giants. The market's trajectory in 2026 will not be determined by corporate earnings alone. It will be heavily influenced by the macroeconomic environment, particularly the actions of the Federal Reserve. The central bank is engaged in a delicate dance, attempting to guide the economy to a soft landing, a scenario where inflation returns to target without triggering a recession. As of January 2026, the federal funds rate sits in a range of 3.50% to 3.75%. The consensus expectation is that the Fed will initiate incremental rate cuts throughout the year, with many analysts, including those at Goldman Sachs, projecting 2 25 basis point cuts in 2026. This easing is predicated on the assumption that inflation will continue to moderate. The inflation outlook is cautiously optimistic, but not without risk. Core personal consumption expenditures, or core PCE, the Fed's preferred inflation gauge, is forecasted to fall into a range of 2.1% to 2.8% by the end of 2026, moving closer to the Fed's 2% target. This disinflationary trend, coupled with a projected U.S. GDP growth of around 2.7%, outperforming the consensus forecast of 2.0% to 2.5%, forms the foundation of the soft landing scenario. Historically, the S&P 500 PE multiple has risen by 10% to 15% during periods of stable economic growth and non-recessionary rate cuts occurring simultaneously. However, the risk of a misstep is significant. J.P. Morgan Global Research, for instance, forecasts a 35% probability of a U.S. recession in 2026. This is a substantial risk that the market, priced for perfection, is largely ignoring. Furthermore, some economists warn of sticky inflation, potentially driven by renewed fiscal spending or the imposition of new tariffs, which could push the inflation rate back toward 2.7% or even higher. If inflation proves persistent, the Fed's easing plans would be derailed, forcing them to maintain higher rates for longer. This, higher for longer, scenario would severely pressure corporate valuations and increase the likelihood of a recession, quickly turning the bull case into a bear market. Furthermore, the labor market remains a key variable. While some softening is expected, a sudden sharp rise in unemployment could force the Fed to cut rates more aggressively than planned, signaling a recession rather than a soft landing. The Fed AS dual mandate, price stability and maximum employment, means that the 2026 rate path is highly conditional on the delicate balance between a cooling but not collapsing jobs market and inflation that steadily moves toward the 2.0% target. Any deviation from this narrow path introduces significant volatility. Beyond the mega-cap technology trade, 2026 is expected to usher in a new phase of the investment cycle, characterized by a broadening of the market and a shift in capital allocation. One key theme is the mid-cycle acceleration. With U.S. economic growth expected to remain sturdy and the Fed easing financial conditions, cyclical sectors of the equity market are poised for a boost. This includes companies exposed to middle-income consumers and firms tied to non-residential construction, which have lagged behind the technology sector in recent years. This rotation would be a healthy sign, indicating that the bull market is expanding beyond its narrow base. Another significant theme is corporate releveraging. Corporate leverage, while rising, remains low relative to historical levels. As interest rates incrementally decline, companies are expected to take on more debt to fund capital expenditures, share buybacks, and mergers and acquisitions. This great releveraging creates tailwinds for the lending ecosystem and places a premium on stocks that maintain strong free cash flows and a commitment to returning capital to shareholders. Crucially, 2026 is also being framed as the search for value. The wide valuation spreads between the expensive growth stocks and the cheaper value stocks, those trading at lower prices relative to profitability and earnings, suggest a potential rotation. Following a surprisingly strong performance by growth stocks in 2025, a favorable macroeconomic outlook and the mean reversion tendency of markets bode well for value as a factor. Investors will be looking for companies that can benefit from the broader economic recovery and the shift from AI infrastructure spending to AI adoption, which will boost efficiency across all industries, not just the technology sector. This shift suggests that while the AI trade will remain dominant, the opportunities for benchmark-beating returns will increasingly be found through stock picking in sectors that have been overlooked during the initial, narrowly focused rally. Specifically, sectors like industrials, energy, and healthcare, which have lower current valuations and are less exposed to the immediate concentration risk of the mega-cap tech stocks, are expected to see increased capital flows. The rotation into value is a bet on mean reversion and the idea that the economic cycle is maturing, favoring companies with stable cash flows and attractive dividend yields over high-growth, high-multiple technology names. This broadening of the rally is a necessary condition for the bull market to be considered truly sustainable in 2026. No analysis of the 2026 market outlook is complete without addressing the significant external fault lines, geopolitics, and fiscal policy. These risks are difficult to quantify, but have the potential to trigger a market correction regardless of corporate earnings or Fed policy. Geopolitical risk remains elevated. The U.S.-China technology race, particularly concerning advanced semiconductors and artificial intelligence, continues to escalate, creating uncertainty for global supply chains and corporate profitability. Tensions in the Middle East and the ongoing conflict in Ukraine also pose persistent threats to energy prices and global stability. For investors, geopolitical risk has become a permanent feature of the landscape, requiring a premium for stability and diversification. Any major escalation in these areas could instantly reverse market sentiment and trigger a flight to safety, punishing high multiple growth stocks. fiscal policy, and national debt represent a growing structural concern. The U.S. national debt has reached historic levels, fueled by persistent deficit spending. While this spending has contributed to the robust U.S. GDP growth of 2.7%, it raises long-term questions about fiscal sustainability. The high level of debt increases the country's vulnerability to interest rate shocks and could eventually crowd out private investment. Furthermore, the political landscape, with the 2026 midterm elections looming, introduces policy uncertainty, particularly around taxation, regulation, and trade tariffs. A sudden shift in fiscal policy or the imposition of new, broad tariffs could act as a tax on corporate profits and a direct inflationary pressure on consumers, undermining the soft landing narrative. These external risks serve as a constant low-frequency tremor beneath the market's surface. They are the unpriced risks that could turn a valuation concern into a full-blown crisis, reminding investors that the market does not exist in a vacuum, but is inextricably linked to the volatile realities of global politics and national finance. The U.S. stock market outlook for 2026 is defined by a profound and irreconcilable tension. On one side, the bull case is compelling. A technological revolution driven by AI, robust corporate earnings growth projected at 12% for the S&P 500, a resilient U.S. economy growing at an estimated 2.7%, and a Federal Reserve poised to ease financial conditions. This narrative suggests we are in the early stages of a new productivity-driven bull market, one that justifies a higher-than-average valuation. On the other side, the bear case is equally stark. Valuation metrics are at historical extremes. The forward PE of 22x, the Shiller P in the mid-30s, and the Buffett Indicator at a record 222% all scream bubble. The market's extreme concentration in a handful of mega-cap stocks amplifies the risk, making the entire index vulnerable to idiosyncratic shocks. The year 2026 will be a tightrope walk between these two realities. The market has little room for error. The 35% probability of a recession, the risk of sticky inflation derailing the Fed's plans, and the ever-present threat of geopolitical escalation mean that any disappointment in earnings and Fed policy or in global stability could trigger a sharp and painful correction. For investors, the path forward requires analytical rigor and a clear understanding of the data. The market is no longer cheap. The easy gains of the past years are likely over. Success in 2026 will depend on distinguishing between genuine, broad-based earnings growth and speculative excess, and on recognizing that while the technological future is bright, the price being paid for that future is historically high. The question is not if the market will face a test, but when and whether the underlying strength of corporate America is enough to withstand the inevitable pressure of historical valuation gravity.